Hi, I'm Andrew Overman from Location, and each week we answer your burning questions in the mortgage world with the help of our mortgage expert, Michael Webb of Mortgage Republic. Good morning, Michael.
Good morning, Andrew. How are you?
Very well, thank you. This week's question is one that's been answered by a number of people, asked by a number of people, and it's what is the difference, please, between a fixed and a variable rate? What is the difference between a fixed and a variable rate?
Excellent question. So when you take a mortgage, you'll typically take it for a set period of time. Let's say 25 years is very common. You can then fix the interest rate that you will pay for a duration of that 25 years. The most common are 2 years or 5 years. However, there are 3-year fixeds and some longer term ones such as 7 and 10-year fixed in the market, and the odd mortgage that is fixed for the full 25 years. Whichever mortgage broker you're working with, you need to have a conversation with them around what is the most appropriate time for you to be fixing for, and that needs to be a conversation about what's likely to happen in your future, how long you're likely to be in the property, and things like that. Because the majority, if not all, of the fixed rates out there are going to have what's called an early repayment charge, which is a penalty to end the mortgage within the fixed rate period. So you could end it either by going to another mortgage company, selling the property, or coming into some money that you would settle the mortgage off with. So that's how a fixed rate would be. You would know exactly what your payment would be for a set period of time. You would then go on to what is called the lender's standard variable rate if you didn't secure yourself another fixed rate, otherwise known as remortgaging, in time for that to happen. So for example, your fixed rate ends at the end of February, you want a new fixed rate to start on the 1st of March. The lender's standard variable rate is set by the individual lenders. It's based on their internal economics and is not tied to anything at all. And they will vary massively in what those rates are. So we're currently March 2022. Typically, most variable rates are somewhere between the high 3% and 6%, broadly speaking, and there is variation between those. That variable rate, so the standard variable rate will typically have no tie-ins. You're free to leave whenever you want, but the lender can change it at any point when they want, obviously giving you notice that your next payment will be on a different interest rate. So there's little stability there. There are other types of variable rates. So whilst we've been talking about standard variable rate, you can get a discounted rate. That is a rate that is a discount from the standard variable rate. So it might be that the standard variable rate is currently 4% and your product is discounted by 1.5%, which means that you would pay a 2.5% interest rate on a variable basis based on when the lender changes their standard variable rate.
Now, presumably, you still wouldn't have that fixed rate assurance, that guarantee of your monthly repayment.
Of course.
If you were
it's kind of in the title that it is variable and it can change. It can change upwards and downwards based on their internal economics. The other type of variable rate is a base rate tracker. And again, you would take one of these out for a set period of time, be it 2 years, 3 years, 5 years. However, it is much more common for you to have a lifetime base rate tracker. And that would be a product that would effectively just track the Bank of England base rate at an amount above or below whatever the Bank of England set it at for the duration of the product period, be that 2, 3, 5, or the lifetime of your mortgage, which could be 25 years. The benefit of this is to some extent, if you're fairly close to the base rate in what you're tracking at, so let's say you're tracking at 0.25% above, you would basically have a mortgage that follows the general market average and economic averages throughout the 25 years. But again, it's variable. And as we sit here in March 2022, we are seeing a trend of rates going up. So people taking variable rates need to be aware that if that trend continues, your mortgage payment is going to go up and is going to track upwards. Hence, people tend to like stability, like to know exactly what's going to be coming out, at least for a period of time. And that's why fixed rates are so popular. The danger with a fixed rate, however, is that you could have what is classed as a payment shock. at the end of it. So your payment may be fixed at £500 for 2 years. Economic changes happen in the background like they are now, and you're not directly affected by them at the time. When your fixed rate ends, the cheapest you may be able to fix that for is £750, which is a 50% uplift on your mortgage payment. Yet that is the cheapest in the market for you. And that's called, officially, is called payment shock, and people need to be aware of that, particularly nowadays, because interest rates have been low, and a lot of people have experienced the opposite to that, where their payment has been £500 and they've done the remortgage process that we talked about, and maybe their payment's 450 or 420. So they've been able to secure an even lower interest rate. However, there is the possibility that we go into a period where you would secure a much more expensive interest rate. So they're the main products in the marketplace. Any mortgage broker you're working with should explain those to you, get your opinions on which one you feel would be most suitable, explain the benefits and the risks on each, and enable you to be advised accordingly on what's the right product for you to move forward with.
Brilliant. So in summary, a fixed rate gives you the absolute assurance that you will pay a fixed and definitive sum for a set period of time. The pitfalls that you need to potentially be aware of is the payment shock at the end if the economy's moved on in an adverse direction, and the payments that you'll therefore make at the end are significantly more than you have been making historically, depending on the time that you've had that fixed rate. The variable is all about flexibility, but you have to be aware that economic conditions can change that at any given moment. And although you've got that additional flexibility to be able to switch products.
Yeah, well, just to be clear, even base rate trackers and discounted rates are likely to tie you in with an early repayment charge. It's only something like a lifetime tracker that's likely to have no early repayment charges.
So it seems to me there's very little benefit to tracking or having a variable product. What would be the attraction?
The attraction in the past has been that rates have been on a downward trend. So if 15 years ago you took a tracker out, then you may well have started to see your mortgage payments reduce over time, because 15 years ago the base rate was 5%, and within a kind of 3 to 4 year period it became 0.5%. So trackers have other elements to them that are called caps and collars. So a cap would put a limit on how much the rate can go up to. So it might track the base rate at 0.25% above, but have a limit of 5% as the maximum you could pay. So it gives you an element of knowing your worst case. Mm-hmm. A collar would be, well, you're tracking at 0.25 above, the rate will not go below 2%, irrelevant of how low the base rate goes. So you can create a window of where you know it's there, and these have become much more popular as well. However, speak to your mortgage broker, because they'll explain the individuals of each product. Some have them, some don't, but they are features that are within there. A lot of tracker products as well also have the ability to fix at any time. So they have like a switch and fix option. So if you're seeing rates start to increase, you can switch onto that lender's current fixed rate if you wanted to. So some of them have that element of flexibility as well.
That's very interesting what you say there with the collar and caps, because essentially you're gambling on the wider economics of not just that lender, but also the world, I suppose. And when we look at inflation and energy prices and everything that's going on in March 2022 in Ukraine and Eastern Europe at the moment, there are a lot of factors that can affect that. So, well, for me, as you know, I've just taken out a 5-year fixed rate. That's not advice. That's where I saw the market going, and it suited my personal circumstances. But the best advice we can give this week, as with every week, is to get in touch with a mortgage advisor. Michael, if people wanted to get in touch with you, it's michael@mortgagerepublic.co.uk. Your telephone number at the office is
01842 816 120, or you can contact us via our website, mortgagerepublic.co.uk, and there's plenty of information on there as well.
Perfect. I'm Andrew Overman. He's Michael Webb, and we've just delivered Mortgage Matters. Thank you for watching.